You're getting very good at this, Robert.
Well, I said to my team, I don't think I need to come to Hong Kong anymore. I feel like I'm in the room with you, travel less and Zoom more.
Well,
Yeah,
it's the new world. 2020 was surreal,
yeah.
and we'll see what 2021 brings us. But in your letter entitled The Great Demographic Reversal and Predictions for 2021. So we'll make it short, sweet, and Churchillian for our audience. So over to you.
Well, John, I mean, 2020 has been such a surprising year. In fact, we've ended up with a 40% performance in our Bamboo Asia fund, mainly on the back of Chinese technology and healthcare stocks. Three of the big winners were Wuxi Biologics and Shenzhen Innovance, and of course, Bilibili, which is an internet stock. So it's interesting that China really had a very strong market in 2020, and there's about $600 billion that went into the China market from overseas. So my prediction for next year is that many of these trends that have been accelerated during the pandemic this year will continue. In other words, the dollar will stay weak. China will continue to attract a lot of foreign capital on the basis of its stability and higher growth and opportunities in the online and healthcare sectors. And we will see outperformance in the emerging markets for the first time in more than 10 years, I think. And, I think that's also going to be driven not only by Asian technology shares, which obviously are a dominant part. China's about 40% of emerging markets now. Taiwan and Korea, I think combined, are 60 to 70%. So that area is still going to be strong. But the other part of it, of course, is Russia, Brazil, and the other developing countries, India, and they will be driven by commodities. So we expect that metal prices and even soft commodities, but especially copper and those sort of industrial metals, will be pretty strong against a weak dollar. So that will boost the emerging markets globally. But China will be the key to all of it, because China is the key to copper demand. China is the key to capital flows and to where the currencies will go this coming year, I think.
Now, could you add some thoughts on India?
Yes. Well, India had a pretty awful COVID experience in terms of its GDP. I think in the second quarter of this year, it fell over 10%. But now, I mean, I was talking to my Indian colleague, Pradhan, a couple of nights ago, and he says that the earnings forecasts for Indian corporates are being revised up again to about 37% growth in the year from March to March 22. So beginning in the spring, we'll have a very strong rebound in India, and GDP could be in double figures. So I think Modi is still strong despite all these farm protests. The rupee is strong. Interest rates are relatively low, and real interest rates are low. So, for example, we were looking at the property sector, Godrej Properties, DLF, and some of those very strong apartment and house market in Mumbai and Delhi. And I think the private banks, and generally, if you think about banking worldwide, it's under some pressure with these very low interest rates, with the fintech growing and bitcoins and so on. And I think that India is an exception. And I talked about this in some detail with Pradhan, and we feel that the Indian banks still have a long way to go, because the mortgage lending in India is about 5% of GDP. Other Asian economies, it's like 40% of GDP. So there's a very low debt level. India is actually, and I thought it was underbanked, but in fact, what's happened in the last 3 or 4 years is that virtually every Indian, 1.4 billion, has a bank account, because they all have Aadhaar ID numbers, and they receive direct subsidies from the government. So there is a new sort of growing middle class in India, and even the lower class are bank account holders. So this is something quite extraordinary, really, that's happened very fast in India. And I think India will be, over the next 5 to 10 years, the biggest growth market, because it has so much to catch up with China in terms of infrastructure, in terms of exports and in terms of their capital market as well, which has always been much longer established than China and has solid private family-run companies rather than state-owned companies. So we look at India and we see lots of opportunity, a very exciting market for the next few years.
Well, as a codicil, John Maynard Keynes said, if the facts change, I change my mind. What do you do, sir? And
Right.
I think this is very important for investors who are looking at your Indian Ocean Fund to realize that you did change your style
Yes.
for a very good reason. And
Yes.
could you just articulate that?
Absolutely. We had the International Monetary Fund as our principal investor, and they, for reasons of their own, could not have an India-only fund, a single country fund. So they asked us to do a regional fund and to benchmark it against 70% India, 30% the frontier markets of Asia, which included Pakistan, Bangladesh, Sri Lanka, and Vietnam. And the only one we have left now is Vietnam. So we've got out of all these frontier illiquid markets and illiquid stocks within India. So I've eschewed the small cap area in India, and I'm focused on large cap quality companies and mid caps. And I think that is what has made the difference. In the last 12 months, we've turned this fund around. We've focused on really quality, and we've got 20 great Indian companies, a couple of stocks in Vietnam. So it's about 94% India, 4 or 5% Vietnam.
Now, as we conclude, you've got your eye on Japan, and I
Yes.
wonder if you could tell us about that.
Well, I think that's very interesting, John. And in fact, I was fascinated to listen to your colleague talking about Japanese equities on Wednesday morning as being the best play on a strong recovery in China. And we see this with my colleague Rupert Kimber in London. We've been working on the idea that Japanese companies are the most undervalued in the world. They've got lots of cash. They're selling below book value. In some cases, they've got high dividend yields and can increase those dividends and payouts. And they're doing much more share buybacks. So there's a cultural change. And the other person, of course, who spotted this was Warren Buffett when he put $5 billion into the Mitsubishi, Sumitomo, the big trading companies in Japan, which are priced at half book value and 5% dividend yield, and are big plays on trade and commodities and the growth of export and import business from Japan to the rest of the world. So we see some of that cultural shift in very conservative Asian companies like CK Hutchison also using their cash more aggressively, paying out more to shareholders. And that's sort of mirroring what happened 10 years ago, maybe in the US. And suddenly you get the share buybacks, and that has a big impact on performance and relative earnings per share.
Robert, could you give us a snapshot of your background, reference Trimark, who you manage considerable
Right.
amount of money for in Canada, and then also the sale of your Lloyd George Management original business
To BMO. Yeah.
to the Bank of Montreal?
Okay. Well, very briefly, John, I've been in Asia since 1982 and founded our original Lloyd George Management in 1992 with a focus on China and India. And we managed $1 billion funds in each of China and India for Eaton Vance in the US. And I think in about 94 or 5, we were approached by a then very fast growing Canadian group, Trimark, with Bob Kremble and Arthur Labatt as the principals. And they also raised, I think it was about $1 billion in Canada to put in principally China and India. And that did very well. And I think they were merged with
Invesco.
in 2000. And we went on to grow that business to about 17 billion just before the global financial crisis in 2008. And eventually in 2011, we were approached by the Bank of Montreal and we sold to them in 2011. And that was a very successful merger, and BMO were a great partner. But anyway, so we are quite well known in Canada, both to private and institutional investors, and we're very comfortable and happy dealing with Canadian customers.
Well, I've got to do a pitch for you because you deserve it. My view is that anyone who is a true global investor is off their rocker if they don't pay attention to China in that special context and also to India. And
Right.
if people who are interested want to send me an email, I'll put them in touch with you.
I'm very proud to say that for more than 30 years now, we've been a reliable partner based in Hong Kong. Usually we have some stuff in Mumbai as well, but we've always focused on China and India. We may not have beaten the benchmark every year, but consistently over 30 years, we've done about 12% per annum. And, I think we pride ourselves on being conservative, careful in stock picking, and a reliable partner in that part of the world, which, as you say, I mean, you can't ignore. You have to see that China's now a major part of the international capital markets, but India is coming out fast, and I think could be the best bet.
Well, that's a great way to conclude 2020, and we'll wish all our viewers, listeners, the very best in 2021.
Yeah.
And thank you so much, Robert.
Thank you, John, and very happy New Year to you and everyone in Canada.